Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I missed one here, which I wanted to bring up first, and that's the Australian, because when I first did this right here, it was trading between 104 and 107, okay? So it had some, approximately here and here. So this is one of those that violated the range. Now notice though how we made a low here and an immediate snapback, okay? Doesn't matter if you're following your rules as a trader and you're planning your trades. This is called a well, okay? I planned my trade. I planned my stop for if I was wrong, okay? I'm wrong. Prices went against me. I have to close my trade, okay? Now, if you're an option trader, though, and you're holding an option that goes practically to worthless, a nice move like this might bring you back depending on how much time you've got in that option, right? Plus, there might be some repair strategies that we could talk about down the road a little bit into the future, but you know, at the beginning when I plan my trades out, I take what I see on my chart and then I deal with it at that time, okay? Mm-hmm. So this one would have been a loser depending on how you traded it. Have we looked at our Swiss franc? No. But now, my Swiss franc here, which of course I had my nice trend lines. I'm going to have to draw these nasty trend lines here, but that's okay. My bull flag, which was forming over here. First of all, if I extended this down and bought the bottom of the bull flag, I would have coincided with a pullback to support on this area where the breakout happened. So, again, a lot of times when prices break out of here and they retest it, that's an opportunity for an astute trader to take a position with very limited risk. All you would have to use, again, with options is you would try to buy the premiums down here when everybody else is selling in a panic. So sometimes you're really going to get a bargain. And if you do have your trend lines like this for the bull flag, this is the weekly candle where the bull flag is actually breaking out to the possible upside. So here's another currency, the dollar versus the Swiss franc, which is telling you that we may go higher. Okay. Friday will be the key. Friday will be the jobs report, and depending on how far out of line that comes in, the dollar will either continue on its rally or retreat right back into the ranges. Okay? So that's a look at where we are today based on what I planned out at the beginning of the presentation, which I sent to Steve at the beginning of the month. And I think I've covered every one of our currencies. So let's go back over here and switch over to questions.
See, what's interesting is you did send me this weeks and weeks ago, and sort of it's pretty cool to see your mind, because obviously you were thinking that the dollar-yen may rally even in these presentations, and that was many, many weeks ago. So that's pretty neat that you did send me that. Is that how you thinking ahead, and is that, and then you're looking for a trigger? Is that one of the ways that you like to trade?
Every trade has to be, in my world, has to be planned out. Entry, stop loss, profit target. So now we're sharing the desktop, so now I'm thinking to myself, where'd my presentation go? So I can't look at the chat box, I guess is what I'm saying. So maybe you could read off questions if you have them.
Yeah, I can get it back. Let's see.
Cool. Yeah, Steve, first of all, I plan all of my trades, okay? Stop loss, profit target, right away from the beginning. And what I do is that I take my entries and my exits, win, lose, or draw. I can't adjust, and as an option trader, you can't adjust midstream by adding on different positions to kind of balance in that. But I'm more of what you call a directional trader. Okay, so I trade what I see on my chart depending on what's there at the time that I plan my trades, and Weekly charts, you really only have to pay a little bit of attention to it because it takes a whole week for the candle to do its thing. So, yes, that's pretty much what we do.
Let me ask you a question that sort of opens Pandora's box. So I don't like to ask it, although I teach people options, each and every day of the year. So I have to talk about volatility. And I know you're talking about direction. What do you try to do? You try to look at spreads. You look at a common sense approach. What do you do to avoid, a volatility crush or something where the volatility is much different than it normally would be, and somebody that is new to options or that has never traded a certain underlying sort of gets in a position where the volatility could really hurt them?
Well, again, there has been a lot of volatility. These ranges have opened up, expanded, and gone pretty much higher and lower on some of these currencies, okay? But remember, if you're looking at right now at my screen where you see the dollar versus the Swiss franc, once we rallied out of that area and we pulled back, at this point in time, and you're buying calls, you're not buying expensive calls at all. You're buying calls where people see falling prices, the volatility is coming out of them, okay? And of course, if this does become support and you bought enough time, and you've got a little bit of time here, these calls should start to be swelling because you've moved quite a bit of a distance from 101.50 to 104.50 already, right? So as you say, a directional trader incorporating support and resistance and things like I do, I'm not very putting myself in a position to actually overpay for an option. Okay.
Right.
Now imagine what's going on right here to these calls above 105. They're starting to get expensive, right? Because the closer you get to 105, okay, now maybe not so much in the currency markets, but think of some stocks. You could sell calls above the top of a trading range like that and collect a lot of premium, but the spread would be your safest way. That way, you definitely could pick your range and then try to. As long as it stays inside the range, you could do really, really well. So I know you've got some smart guys that come on here and talk about options all the time, and I take everything I hear when I listen to your presentations and try to incorporate it in there. But for me, buying dips and selling rallies is when most people are throwing up their calls and their puts just to try to save some money. So I'm getting bargains as many times as more times than not. How's that?
That makes sense, Steve. Okay, well, let's just take some questions here.
Okay.
Let's see. Michael has a question. He says, you mentioned using a moving average as a trailing stop. Is there a better or a worse way to do that?
Well, a moving average as a trailing stop, I would suppose I would have to show you a chart where it would be probably efficient. Okay.
If you knew it, I'll give you the ball back, and you can go there if you want.
Can you see the charts here?
No, I have to change it back. Okay, so
okay,
I have to make you.
You ask me the questions, and I'll use the charts. How's that?
So now I made you. You're the presenter again. You can go and I think. Wait a second. Are you looking at your presentation or are you looking at your desktop?
I'm looking at the desktop.
Okay, so now you're going to have to go and share.
Share the desktop again. Okay.
Again, right.
Got it.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.